Welcome to another daily recap. Today is Wednesday, December 2023. It's about 8:15 a.m. Eastern right now, over an hour before the market opens. And here are 6 levels that have been calculated to trade against today. The vertical dotted line on the left is where the SPY or spiders closed yesterday, Tuesday, December 19. And everything after this vertical line will be today's activity in the spiders. After the market closes today, we'll check back to see how the spiders reacted off these levels and discuss trades that were entered based on these numbers. Currently in the pre-market, the spiders are right below 474, as you can see in the upper left side of your screen. And now the market has closed for the day. Again, today is Wednesday, December 20. It was an interesting day to say the least. I entered no trades today, and that turned out to be a good thing because if I played by the rules of the strategy without giving regard to any other indicators on my other screens, today would have been a bloodbath. I'll explain. After 9:45 a.m., the spiders were heading up toward this 474.80 level. Since this last month and a half has been in an uptrend, the more prudent trade in a bullish environment like this will be to buy pullback. So I would have preferred if the spiders came back to the 474.02 level before going higher, but they don't always hand you the trade exactly as you would like it. So when the spiders got near the 474.80 level, I had an order in the system to sell E-mini contracts short if the spiders touched 474.75. But they stalled out right below this area and went sideways for about 15 or 16 minutes. That was enough for me to wonder if something else was going on and to second guess the trade. When you see that kind of behavior right below or above a calculated level, it's usually an indication that they are building up steam to bust through the level. And as you've seen in other recap videos I've made, there is also a similar scenario where they come up within pennies of activating a trade and then bounce away for what would have been enough to satisfy the base hit. In those cases, I call it a near miss and cancel the activation of the trade at the original level. And in this case today, it was a bullish consolidation under the level. And I canceled the activation and waited to see what would happen. And sure enough, they built up enough steam to bust through the level and then just hung out above for a while. And it was about noon when I closed up shop and went into the office to get other work done. Most good trades happen in the morning anyway, so no trade in the books for me at this point in the day. But when I pulled up the chart this evening to analyze what happened for the rest of the day, obviously the rug was pulled out in the afternoon and the spiders collapsed. So what I want to do is treat this day as if you are strictly adhering to the rules of the strategy without regard to other indicators that would and should have been used. So here's what would have happened. First, if you took the short trade at the 474.80 level, which wouldn't have been a good idea, but if you instead of taking this bullish consolidation seriously and bowing out of the trade, you would have been out of the money as they busted through. And about an hour and a half later, you would have incurred a 6.5 point fumble and reversed the position. The reversal would have given you a base hit back and washed out most of the loss. So by the time the spiders were on their way back down in the afternoon, you would have started the rest of the afternoon with a negative 2.5 ES points. Not terrible, but this is when things would have really started to get sticky. So the 474.80 level would have been off the table at this point, and a long trade at 474.02 would have been in the system because it was never hit before 9:45 or after 9:45 in the morning. So this trade would have been activated, and as you can see, it would have been immediately wrong. There was a little bit of a pause and a bounce before they got to level, but not enough to be of concern. So this trade would have been activated on the long side. And as I've mentioned before, I use a variety of other charts and indicators for real-time analysis. It was right around here, around 15 or 20 minutes before 2 p.m. that sellers just started to flood the market. And yes, there are levels that are on the board, and they're there for a reason. There are formulas used to calculate these levels, and they are precise and objective, and the math works the vast majority of the time. So it is very unusual for there not to be some kind of reaction at or near these levels. So when they don't consolidate or give you a near miss, but instead fall through like the level isn't even there, that's a sign that something else is going on. In this case, sellers were showing up in droves and selling begat selling. So this signal, or the signal that this first position would have been a fumble, did materialize down here right before the next level. So instead of reversing, the rule is to buy again and average in. And this is because the proximity to where the fumble signal occurred. But as you can see, that would have been doubling down on a bad thing, and this trade would have started to look very ugly. In cases like this, I have a maximum loss limit that I use. And this is a function of my margin balance, the risk based on and considering the risk that I'm willing to incur for each trade that I enter. So the maximum number of ES contracts that I trade is 2. So at that number, with consideration to the current account balance, the most ES points I'm willing to lose on a single trade is 20. With these trades both adding to the long position, that threshold was hit before the spiders got down to the lowest level at 470.72. So if I were trading this in real time, and I'm glad I wasn't, I would have jumped out or jumped ship at the 20-point mark and called it a day. So an adventurous and risky trader may have changed course at some point and went short when it became clear that a sell operation was underway. And that probably would have worked for a while, but you would have no idea at what point they might whip you back in the other direction. So you take this 470.72 level, for example. That level worked great for a bounce. So had you panicked and reversed your long position somewhere around here, odds are you would have been scorched on the other side of the trade as well, since the spiders did exactly opposite of what you would have wanted with these interim bounces. In any case, it was one of those days where if you'd been trading the levels all day and sticking to the rules, you would have given some money back to the market. And that is what I'm inputting into the tracking log to be fair and keep the averages accurate. Although thankfully I wasn't in any trades and therefore made $0 and lost $0. Here is the first trade at the 474.80 level that would have resulted in the 6.5-point fumble and the base hit on the reversal. And the rest of these levels would have netted a 20-point loss for the day as they were closed out, as they were averaged in, or they begin to get averaged in. And since this is a long-term strategy and that depends heavily on the law of averages, you take the bad with the good and move on. And incidentally, I will not be trading on Friday or this Friday and next Tuesday, the day before and after the Christmas break. The market will be closed on Monday, of course. And Friday and Tuesday just aren't days I want to be in the market. I'll continue to do daily recap videos to analyze what happened during the trading day based on these calculated levels. But I'm just pointing out that the time frame around holidays like this just aren't good times to be putting money at risk, in my opinion. So that's all I have for today. I hope you found this information interesting and helpful. Have a great day.